Good afternoon, and welcome to Pries Capital's March 2026 Market Trading Report. I'm Jason Pries. Before we begin, an important reminder. This presentation and the associated webcast are for informational and educational purposes only. Nothing here should be interpreted as a recommendation to buy, sell, or hold any security, and nothing here is personalized investment advice. The figures and charts we reference are compiled from sources we consider dependable, but markets move, economic series can be revised, and conclusions evolve as the evidence evolves. Pries Capital and/or I may have exposure to some of the asset classes, strategies, or companies referenced today through our own portfolios, projects, or research programs. That does not change the discipline of our process. If anything, it raises the standard. We approach this analysis with accountability to risk, an eye for regime change, and a commitment to evidence over narrative. This full report was released March 5, 2026, and it's built to be advisor-ready. Use these visuals in your own presentations. Share them with clients, prospects, colleagues, or followers online. The job today is simple. Translate a complex set of cross-asset signals into a positioning plan you can execute with conviction. Markets can look calm on the surface and still be rotating aggressively underneath. That's why we don't manage portfolios off headlines. We manage them off evidence, leadership, breadth, policy direction, and the parts of the market where risk is being repriced. If you're not yet a Pries Capital client, this deck is an invitation. Start a free trial, book a demo, and let's have a real conversation about how you're building portfolios, communicating with clients, and navigating regime shifts. And for existing clients, remember you can have your firm logo added to all charts, which makes client communication cleaner and more consistent. Now let's move into performance, because performance tells the truth about what the market is actually rewarding. We start here because asset class performance is the market's scoreboard. It tells you whether opportunity is broad and durable, or narrow and fragile. When leadership is broad, you can build portfolios that compound without relying on one trade. When leadership is narrow, you have to manage concentration and hedging far more deliberately. At this stage of the cycle, the key is selectivity. You want exposure to return engines that can compound through different weather, and you want risk controls that prevent one sleeve from hijacking the portfolio. The goal is not to be risk on or risk off. The goal is better risk. Right exposure, right sizing, and clear exit rules when the tape shifts. Use this slide with clients to set expectations. When you can show that returns are coming from multiple places, not just one index, you reduce emotional decision-making. And when you can show where performance is lagging, you can explain why we are cautious about chasing the far right tail. Now, before we go into equities, the deck calls out an important industry-level stress point. It matters because it's a perfect example of how index stability can mask meaningful internal repricing. February revealed a growing divergence beneath the surface of the market. While the broad index stayed relatively steady, software sold off sharply. Renewed pressure across the software as a service landscape. The reason this matters is not software is dead. The reason it matters is what it reveals about the market's current pricing model. Investors are now demanding defensibility and clarity, not just growth narratives. Artificial intelligence is accelerating that scrutiny. Investors are asking, which platforms can integrate artificial intelligence effectively, and which platforms face margin compression or displacement risk. This is not necessarily a collapse in fundamentals. Revenues and earnings generally held up. What changed was expectations. Valuations had been priced for near-perfect execution, and even modest adjustments in guidance can trigger repricing when the multiple is stretched. For advisors, this is a high-quality teaching moment. February reinforced an important reminder: index stability can mask rotation underneath. That's why portfolio construction matters. If you're concentrated in the wrong pocket, you can underperform meaningfully even when the index looks fine. The playbook in environments like this is to stay disciplined, own durability, insist on cash flow, and avoid paying peak multiples for unproven defensibility. Now we transition into equities. This section is sequenced to answer the questions clients care about most: what led, what lagged, and what that implies for positioning. We'll move from major index performance to style, value versus growth, then sectors, then dispersion through the best and worst performers. Here's the core idea. Leadership tells you what the market is paying for right now. And in early 2026, leadership is not one note. We're seeing a strong international bid, a measurable style rotation, and sector leadership that's defensive in one place and cyclical in another. That blend suggests a market that is balancing growth uncertainty, policy expectations, and valuation discipline all at once. Our job as allocators is to treat this as a regime to be navigated, not a story to be believed. That means keeping core exposure to the highest probability return engines, while broadening into the areas the market is rewarding without chasing. It also means tightening risk controls around the pockets that are being repriced, like software, because those repricings can be contagious when sentiment shifts. Let's start with the index scoreboard. On a trailing 12-month basis, emerging markets are up 50%, and all indices are positive over 13%. That's breadth, global participation, not a narrow one-trade market. Now zoom into February 2026. Emerging markets led again, up 5.5%. This matters because persistent leadership outside the U.S. changes the opportunity set. It doesn't mean you abandon U.S. core exposure. It means you respect the evidence that capital is rotating and broadening. Keep your U.S. core funded, but stop treating international exposure as optional. When global leadership is strong, home bias becomes a tax. At the same time, don't chase. Scale exposure systematically and use risk gates. If global leadership breaks, you reduce first at the edges. The takeaway I want you to communicate to clients is, we are not guessing. We are observing leadership and positioning accordingly, owning the parts of the market the tape is paying while keeping risk controls tight. February delivered a clear style message. Large cap value led, up 2.5%, while large cap growth fell 3.4% on the month. On the trailing 12-month window, small cap value leads at 24.9%, with small cap growth moving into second. This is more than a trivia point. Style tells you the market's risk preference. Value leadership often coincides with broader participation, less tolerance for premium multiples, and a higher bar for narrative-driven growth. Growth can still work, especially the highest quality cash flow growers, but you can't pay any price and expect the tape to carry you. So what do? We broaden intelligently. We keep quality in the core, but we allow a value tilt where fundamentals support it. We emphasize balance sheets, free cash flow, and pricing power. And we treat growth exposure as a quality filter exercise, not a sector label. This slide is your permission slip to explain rotation without sounding reactive. We aren't abandoning growth, we're repricing what we're willing to pay for growth. Sector leadership in February was loud. Utilities surged 10.4%, while financials lagged -3.8%. Over the trailing 12 months, industrials lead at 31.7%, and financials have fallen negative. This tells you the market is paying for a mix of defensiveness and real economy strength, but it is not paying uniformly. Utilities outperformance often reflects a desire for stability, yield, and lower volatility exposure. Financials weakness often signals concerns about credit quality, margin pressure, or the macro path. So don't assume sector beta is interchangeable. In this tape, your sector selection is a risk decision. We want exposure aligned with durability and with the prevailing leadership, but we do it without chasing. When a sector runs hard in a short window, we rebalance, not become emotional buyers. February is a reminder that sector positioning matters as much as equities versus bonds. If you want a smoother experience and better long-run compounding, you must manage the internal mix, not just the headline allocation. The winners list is about dispersion. It shows where the market is rewarding catalysts, margin durability, and repricing. In a month with style rotation and sector divergence, the top performers typically cluster around specific themes: defensiveness, commodity impulse, idiosyncratic catalysts, or balance sheet surprise. Here's how I want you to use this list in practice, not as a buy list, but as a map of what the market paid for and why. Ask 3 questions. First, what factor is being repriced? Second, is the move a one-month phenomenon or part of a trend? Third, can we express the same exposure with less idiosyncratic risk, like through a basket, a sector, or a more liquid proxy? This is where advisors can add real value. Clients see a winner and feel fear of missing out. Your job is to reframe, we're not chasing headlines, we're building compounding exposure with risk controls. If a name belongs, it belongs because fundamentals and risk budgeting justify it, not because it printed a big monthly bar. The laggards list is where risk management shows itself. Even when indices are constructive, the market still punishes weak balance sheets, deteriorating margin structures, and narratives that fail under scrutiny, software being the clean example this month. The portfolio takeaway is direct. Beta is not a substitute for underwriting. When dispersion rises, you have to be willing to prune. The decision tree is simple. Is the thesis intact, or did something break? If the thesis broke, you reduce. If the thesis is intact but the market is repricing, you size appropriately, demand better entries, and use risk controls that keep one position from contaminating the whole portfolio. This slide is also a client education tool. It helps explain why we sell. We don't sell because we are emotional. We sell because the probability-weighted outcome changed. In an environment where leadership rotates, preserving capital is the first step toward compounding capital. Now the engine room. Economic data. We're going to connect employment, inflation relative to policy, housing and mortgage rates, the divergence between services and manufacturing, and the risk sentiment signal from Bitcoin's drawdown. The objective here is not to forecast with false precision. It is to identify regime. If employment is cooling without collapsing, that supports a soft landing. If inflation is evolving relative to the policy rate, that shapes real rates and valuation. If housing is stabilizing, that affects confidence and credit. And if services and manufacturing diverge, it tells you where the economy is strong and where it is fragile. The macro message should always translate to portfolio decisions: where to take risk, where to reduce, and which hedges are likely to work. The best advisors do not compete with prediction, they compete on process. Let's start with employment. Employment remains the cornerstone variable. When labor holds, consumption holds. When labor cracks, markets reprice fast. The key for 2026 is trend, not one print. Are conditions cooling gradually, allowing inflation to normalize, or deteriorating sharply into contraction? A stable to cooling labor market tends to support a balanced approach. Equities can hold multiples if earnings remain reasonable. Fixed income becomes more attractive as the policy path leans toward easing or neutrality. Credit becomes more nuanced. Carry can work, but underwriting matters because weak borrowers are exposed when growth slows. The messaging is clarity. We're monitoring labor as a risk trigger, not as a headline generator. Our positioning adapts as trends confirm. That's how we avoid whipsawing. This is the fulcrum chart because it defines real rates. When inflation moderates and policy remains restrictive, real rates rise and valuation compresses. When policy shifts and inflation stabilizes, real rates fall and both equities and duration can breathe. The portfolio implication is not to guess the next data point. It's to position duration intelligently and insist on quality in equities. Higher real rates punish long-duration cash flows and premium multiples. Lower real rate pressure supports quality growth, but only if fundamentals remain durable. This also affects how you explain bonds to clients. Bonds are not just income, they are portfolio stability and optionality. In environments where rate expectations change quickly, owning the right duration exposure can reduce drawdowns and improve long-run compounding. Housing is where policy becomes real. Mortgage rates impact affordability immediately, and affordability impacts transaction volume, construction activity, and consumer sentiment. That's why this slide matters beyond real estate. Housing is a transmission channel. If mortgage rates are stabilizing or easing, housing can find a floor, but that does not guarantee a surge in activity. The market can remain rate-sensitive and inventory-sensitive at the same time. For portfolios, the takeaway is to be selective. Favor businesses with balance sheet strength and pricing power, and be cautious about exposures that require cheap capital to work. This is a practical slide. It connects rates to a client's lived experience. That makes macro positioning easier to explain. We're not watching rates for fun. We're watching rates because they shape the real economy. A two-speed economy matters. When services remain resilient and manufacturing stays softer, you can have an economy that feels fine to consumers even while goods-producing segments struggle. That divergence drives sector leadership and earnings dispersion. Avoid one-narrative portfolios. Pair core exposures to durable cash flow with selective cyclicals only where the evidence supports it: order books, revisions, balance sheets, and end demand visibility. For fixed income, this divergence supports a balanced duration posture. If manufacturing weakness deepens, duration can provide ballast. If services strength keeps inflation sticky, your diversification and risk controls matter. This slide explains mixed headlines. Strong economy and weak economy can both be true depending on the sector. Our job is not to argue with headlines, it's to position across the drivers. Bitcoin's drawdown matters because clients ask about it, and because it often reflects liquidity preference and speculative appetite. When liquidity tightens or risk appetite fades, speculative assets tend to underperform. That doesn't necessarily predict the next move in equities or bonds, but it is a helpful sentiment signal. Crypto is not a substitute for a disciplined hedge sleeve. If an investor holds it, it should be sized as a high volatility satellite, not as a core hedge. The job of hedging in a professional portfolio belongs to more reliable instruments: duration, cash, and defined risk structures. This slide is also a reminder. Volatility is not confined to equities. In 2026, the market is repricing narratives quickly: software, crypto, and any area where expectations outrun defensibility. That means your best edge is discipline. Don't let a high volatility sleeve dictate the risk profile of the entire book. Fixed income is back at the center of portfolio construction, not just for income, but as a volatility and drawdown management tool. This section focuses on the U.S. Treasury yield curve and the performance of select bond exchange-traded funds. Our job is to place duration where it offers the best risk-adjusted return, balancing carry, roll-down, and convexity while managing the risk that the long end can be dominated by issuance, term premium, and inflation uncertainty. The key message is that bonds are not one thing. Different maturity segments behave differently, and different credit qualities behave differently. A professional fixed income sleeve is built as a system: quality core, selective carry, and a hedge component that pays when risk sells off. Let's start with the yield curve. The yield curve is the market's macro summary. It embeds growth expectations, inflation risk, and the policy path. The key is not to predict every tick. It's to decide where you're being paid for time and where you're simply absorbing volatility. A disciplined approach typically favors the intermediate segment when the policy path is uncertain. You capture meaningful income and convexity while avoiding the extreme sensitivity of ultra-long duration. The long end still has value, but often as a hedge component rather than the primary income engine. The curve helps explain why bonds belong in a portfolio even after volatile rate cycles. Bonds provide stability and optionality. When equities wobble, the right duration exposure can reduce drawdowns and improve the probability of compounding over time. This slide makes the fixed income translation practical. In February 2026, long-duration treasuries surged 4.6%, while high-yield corporate bonds were flat. On a trailing 12-month basis, high-yield corporate bonds are up 7.8%, and all other categories are positive. What does that mean? Duration worked as a hedge and return contributor in the month, while lower quality credit did not pay you for the risk. That's exactly why we treat high yield as a conditional sleeve, something you hold when credit is healthy and cut first when risk rises. Build fixed income as a system. Keep a high-quality core for stability and income. Use long duration tactically when it is rewarded and when it hedges equity risk. And treat high yield as a carry sleeve with a strict gate, not a permanent allocation. This slide is client-friendly. It helps explain why bond performance depends on duration and credit, not just the word bonds. To close, here's the Pries perspective. Markets in early 2026 are rewarding discipline. Index-level calm can hide meaningful rotation underneath, as we saw in software. Global leadership remains strong, as we saw in emerging markets. Style is rotating. Value leadership and growth repricing can happen quickly. Sector leadership is not uniform. Utilities can surge while financials lag. And in fixed income, duration can reassert itself fast, while high yield demands selectivity. The portfolio playbook is clear. Maintain a quality core, broaden intelligently where leadership supports it, and keep risk controls tight in areas being repriced. Use the yield curve and bond performance to manage volatility, not just to chase yield. For more information or to start a free trial, please visit www.priescapital.com. Full disclosure is available on our website. Thank you for your time. I'm Jason Pries, and I'll see you on the next one.